In 1792, Wall Street was a dirt road, and brokers gathered under a sycamore buttonwood tree to sort out trades. On May 17th of that year, 24 traders signed the Buttonwood Agreement, creating the first U.S. stock trading club. This pact set fixed commissions and limited trading to members. Within a few years, the group moved indoors to the Tontine Coffee House, and in 1817, formally organized as the New York Stock and Exchange Board. In 1863, it took the name New York Stock Exchange, which endures today. Thus began the organized U.S. stock market. As America industrialized in the 1800s, factories, railroads, and oil empires fueled a stock market boom. The growing market needed benchmarks. In 1896, newspaper editor Charles Dow launched the first Dow Jones Industrial Average, a 12-stock index of leading industrial companies. Investors could now track the market through one number. Over time, the Dow and other indexes became vital tools for guiding investors through America's Gilded Age of steel barons and robber princes. The Roaring Twenties euphoria came to a shuddering halt in October 1929. After a decade of surging prices, the market crashed. On Black Monday, October 28, 1929, the Dow plunged 13% in one day. Panic deepened on Black Tuesday, October 29, and in the months after. By July 1932, the Dow was some 89% below its 1929 peak. The crash wiped out vast wealth and helped trigger the 12-year Great Depression. In response, Congress passed reforms like the Glass-Steagall Act to stabilize markets and later created the SEC in 1934. After World War II, America's economy roared back. Homes, cars, and factories sprouted. The stock market rose too. By 1954, U.S. markets had recovered all their pre-depression value and were breaking new highs. A wave of mutual funds gave middle-class investors easy stock exposure. Roughly 50 new funds launched in the 1950s. In this era, Standard & Poor's introduced the S&P 500 index in 1957. The S&P 500 tracked 500 of the largest U.S. companies, 425 industrials, 25 railroads, 50 utilities, about 90% of the country's market value. This broad, market cap-weighted index became a popular benchmark. With more people investing, stock ownership gradually spread beyond Wall Street to Main Street. Markets marched higher into the 1980s until another flash crash. On Black Monday, October 19, 1987, the Dow Jones fell 508 points, about 22.6% in a single session. It was the largest one-day percentage drop ever. Circuit breakers, automatic trading halts, were soon added to prevent such free falls. After recovering, the 1990s brought a different frenzy. The rise of the internet sparked the dot-com bubble. From 1995 to 2000, the NASDAQ index, heavy in tech stocks, rocketed from under 1,000 to over 5,000. Then it crashed. By late 2002, the NASDAQ had lost roughly 77% from its peak. Many dot-com companies failed. The bust erased billions and taught investors the danger of chasing wild tech dreams. The early 2000s saw new shocks. Terrorist attacks on September 11, 2001 shut down U.S. markets for days. When trading resumed, stocks initially plunged but recovered within months. A much deeper crisis hit in 2008. Years of loose lending had inflated a housing bubble, and by 2007, mortgage problems were surfacing. In September 2008, Lehman Brothers collapsed, the largest U.S. bankruptcy ever, triggering a global panic. The stock market tumbled. By March 2009, the Dow had fallen over 50% from its pre-crisis high. The economy plunged into the Great Recession. Governments and central banks intervened with bailouts and stimulus. Back in Washington, Congress passed the Dodd-Frank Act in 2010 to prevent a replay, creating tougher bank capital requirements, stress tests, a new Consumer Financial Protection Bureau, and other safeguards. The next market crater came in March 2020. As COVID-19 spread, fear gripped investors. From February 12 to March 23, 2020, the Dow plunged about 37%, one of the fastest market declines ever. In mid-March alone, the Dow fell over 1,000 points in a day. But the sell-off was short-lived. Massive Federal Reserve easing, fiscal stimulus, and the resilience of big tech companies fueled a dramatic rebound. By August 2020, the S&P 500 was hitting fresh record highs. In fact, just a handful of mega-cap tech firms drove much of the rally. Companies like Apple, Amazon, and Microsoft soared, collectively providing more than half of the S&P 500's total gain in 2020. In sum, the pandemic crash was the briefest bear market on record, followed by a near vertical recovery led by tech and growth stocks. Just as markets seemed normalizing, new players arrived. Millions of retail investors flocked to markets through smartphones and social media. Commission-free trading apps like Robinhood and social forums, e.g. Reddit's Wall Street Bets, made stock trading easy and social. In January 2021, this new crowd caused an epic market event. GameStop's struggling video game retailer stock soared as Reddit traders bought in to squeeze short-selling hedge funds. According to analyses, a large increase in trading by retail investors using the Robinhood platform, organized via social media, drove GME's surge. This meme stock phenomenon, also seen in names like AMC and others, showed how ordinary investors, empowered by fintech, could move markets and challenge Wall Street veterans. Fast forward to spring 2025. Markets are still bustling with change. Economists caution that volatility may stay high amid mixed signals. Growth has cooled and inflation remains stubborn. One analysis notes that slower growth and higher inflation are likely for the rest of 2025, and trade policy uncertainty is keeping markets choppy. Fed rate cuts may be limited for now. Investors are favoring lower volatility sectors and defensive strategies in this environment. Meanwhile, one powerful theme stands out: artificial intelligence. Firms boosting AI research and data center spending should benefit from this trend. In the words of analysts, AI remains a durable theme, backed by big capital expenditures and falling compute costs. Thus far, the market is heavily weighted toward tech leaders, the so-called Magnificent Seven, while older sectors like energy or finance have lagged. In short, 2025's markets show cross-currents of Fed policy, geopolitical risk, and a tech-led updraft, meaning investors need to be nimble. Despite all the highs and lows, some truths endure. Experts emphasize diversification, spreading your money across many stocks, bonds, and sectors to reduce risk. Historically, staying invested over the long haul beats trying to time every turn. That's why many pros recommend low-cost index funds that simply mirror a broad market index, like the S&P 500. Index funds offer built-in diversification and minimal fees, so investors can capture the overall market's growth without gambling on single winners. In any era, patience and a broad portfolio tend to triumph over panic and speculation.